Well, 6 days ago, DIMON told investors in New York that his bank, the country's most profitable, probably will not hold mortgages on its books if the Fed requires the largest lenders to hold extra capital. For more, we are joined by Wells Fargo chief economist John Silvia, Dominic and Sara Eisen now joining me as well. And John, I mean, whose side do you side with? Is it Jamie Dimon or is it Ben Bernanke?
Well, the reality, I think for most people who have worked on Capitol Hill, as I have, is that Congress will pass rules and laws, but it's actually the agencies that will interpret these. And when you looked at Dodd-Frank, what you realize is that there were a lot of studies proposed and a lot of rulemaking that was to be taking place, and it's going to take time. It takes 6 months, maybe a year, sometimes 2 or 3 years to get all these rules into place. In the meantime, the challenge is that you have a lot of institutions and lenders and mortgage brokers and everyone else who simply say, I don't know really what the rules are. And so therefore, I'm not going to engage in a lot of economic activity that I might find is not going to be profitable a year or two after the rules are put in place. And I think this applies both in terms of financial regulation, but also in terms of fiscal policy. A lot of people right now don't know if their taxes are going to go up, don't know if the programs that they have in terms of serving the government are going to be cut. That creates a lot of uncertainty, and therefore, no, it's not surprising the economy has a lot of trouble getting going. It's not surprising that job hiring, even at a pace of 150,000 so far year to date, is subpar, given the policy uncertainty that is the reality of Congress passing laws, but having agencies put them into effect, you know, over a period of 6 months to 2 years.
Hey, John, it's Sara. You're an economist.
Sara.
Uncertainty is one thing, but the rules under discussion, the rules that you've looked at in Dodd-Frank, are they harmful to the economic recovery?
Well, the challenge, as you know, Sara, is that when you try to say we're going to be tighter in our regulation, we're going to be more restrictive, essentially what you're also saying is we're going to be taking less risk going forward. And generally, when you take less risk and you become more cautious, there simply is less economic activity. And I think that's exactly part of what you see right now.
Hey, John, it's Dominic here. One of the things we talk about with financial industries and in the sector overall is that the loss of jobs there, we're talking 4 years in a row of job losses through 2010. That's according to the BLS. If the jobs aren't going to be in finance, where are the jobs going to be when and if they do ever come, John?
Well, the jobs you probably might imagine are going to come in the higher education professional services area. So you're talking about information and technology. You're talking about professional and business services. You're talking about education and healthcare. The challenge in these areas, though, is you do need the education to be there. And I think what we saw over the prior decade is a huge buildup in, let's say, construction jobs, many of which did not require a college education. So a lot of those people in those jobs are not going to get the jobs that we're looking at in the 21st century that do require the higher education.
John, why do you think Ben Bernanke did this yesterday? He basically dashed any hopes of further stimulus, but at the same time expressed more concern about the economy, that it's just not recovering as quickly as some would expect.
Well, I think if you look at the FOMC's economic projections that came out in February earlier this year, clearly expecting 3 to 3.5% growth this year was a little optimistic even at that point in time. And I think you just said, listen, it's more realistic that we lower perhaps our economic expectations, but also suggesting that we're not going to be pulling back any of this tightening. We're not going to be shrinking the balance sheet. We're not going to be, lowering any of our standards here, but we're not going to be raising interest rates at all. So I think he said simply, listen, we find the economy disappointing, not as strong as we expected. We're certainly not going to do anything in terms of monetary policy, and I think he's got it right. I think monetary policy is on hold for the rest of the year, and the Fed will not be raising interest rates.
John, thank you. Appreciate your time.
Sure.
John Silvia of Wells Fargo.